Have you noticed something unusual happening across the global financial system? Three of the biggest names in the world appear to be moving in the same direction at nearly the same time. China is increasing its focus on gold reserves. India continues showing strong physical demand for precious metals. JPMorgan has remained deeply involved in the precious metals market while closely watching changing economic conditions. Is this just another coincidence? Or are these signals pointing toward something much bigger that most investors have completely missed? Today we are breaking down why these powerful players appear to be making similar moves and what it could mean for the future of gold, silver, and the global financial system. Because if history has taught investors anything, it is that when major institutions and large economies begin moving together, smart investors pay attention. Welcome back to Silver and Gold Watch. If you enjoy honest market analysis and want to stay ahead of the biggest trends shaping precious metals, make sure you subscribe because this story could become one of the most important developments of the year. Over the past several years, global markets have experienced constant uncertainty. Inflation reached levels not seen for decades. Interest rates climbed at the fastest pace in many years. Banking stress appeared unexpectedly. Geopolitical tensions increased across multiple regions. Government debt continued reaching record highs. Yet despite all these challenges, something remarkable continued happening behind the scenes. Central banks kept buying gold. Investors quietly accumulated physical precious metals. Industrial demand for silver remained surprisingly resilient. While headlines focused on stock markets, technology companies, and daily political events, some of the world's largest financial players were preparing for a very different future. China has become one of the largest official buyers of gold in recent years. Many analysts believe this reflects a long-term strategy to strengthen financial stability, reduce dependence on foreign currencies, and diversify national reserves. Instead of holding only paper assets, China has steadily increased ownership of physical gold. Gold provides something unique. It carries no default risk. It cannot be printed by governments. It has maintained purchasing power throughout thousands of years of economic history. During periods of uncertainty, these qualities become increasingly valuable. India tells a different but equally fascinating story. Unlike many countries, gold ownership in India is deeply connected to culture, family savings, and long-term wealth preservation. Millions of households regularly purchase gold, regardless of short-term price movements. During wedding seasons, festivals, and periods of strong economic growth, physical demand often increases significantly. This consistent buying creates one of the strongest foundations for global gold demand. But recently, interest in silver has also expanded. Industrial growth, renewable energy investments, electronics manufacturing, and rising investor awareness have all contributed to stronger long-term demand for silver across India. Then there is JPMorgan. As one of the largest financial institutions in the world, its activity within precious metals markets receives enormous attention. Large banks manage risk, provide liquidity, facilitate trading, and monitor economic trends that influence commodity prices. When institutions of this size actively participate in precious metals, markets investors naturally begin asking important questions. Are they preparing for higher inflation? Do they expect increased market volatility? Are they positioning for future monetary policy changes? Or are they simply responding to changing customer demand? These questions do not always have simple answers, but history shows that institutional behavior often provides valuable clues about broader economic expectations. One major reason these different players may appear aligned involves uncertainty surrounding future monetary policy. For several years, central banks aggressively increased interest rates to fight inflation. Higher rates generally strengthen the US dollar and create pressure on precious metals. However, markets constantly look ahead rather than backward. As inflation gradually moderates, investors begin wondering when future rate reductions might begin. Lower interest rates often improve the outlook for both gold and silver because the opportunity cost of holding precious metals decreases. That possibility has attracted growing attention from institutional investors around the world. At the same time, governments continue carrying enormous debt burdens. Servicing that debt becomes increasingly expensive when interest rates remain elevated. Many economists believe future policy decisions must balance inflation control with economic growth and financial stability. This creates uncertainty that often supports safe haven assets. Another powerful trend involves diversification. Countries around the world have gradually reduced concentration in single reserve assets while expanding holdings across multiple asset classes. Gold has become an increasingly attractive component of that strategy. Unlike government bonds, gold carries no credit risk. Unlike currencies, gold cannot be created through monetary expansion. Its limited supply gives it characteristics that many central banks value during periods of financial uncertainty. Silver also benefits from changing global priorities. Unlike gold, silver serves both as a precious metal and a critical industrial material. Solar panels, electric vehicles, advanced electronics, medical equipment, and artificial intelligence infrastructure all require silver. That combination creates demand from both investors and manufacturers. If industrial expansion continues while investment demand increases simultaneously, silver could experience stronger long-term support than many investors currently expect. One of the biggest mistakes investors make is assuming that precious metals only perform well during economic crises. History shows that is not always true. Gold and silver have often delivered strong performance during periods of economic expansion as well. The reason is simple. Their prices respond to multiple forces at the same time: inflation expectations, interest rate policy, currency strength, industrial demand, investment demand, geopolitical uncertainty, central bank activity, and overall investor confidence. When several of these factors begin moving together, precious metals can enter powerful, long-term trends. That is why experienced investors rarely focus on only one headline. They watch the complete picture. Take the US dollar, for example. For decades, the dollar has remained the world's dominant reserve currency. Most international trade continues using dollars. Many commodities, including gold and silver, are priced in dollars. Because of this relationship, changes in dollar strength often influence precious metals. When the dollar strengthens, gold and silver sometimes face temporary pressure. When the dollar weakens, precious metals often become more attractive for global investors. However, this relationship is not perfect. There have been periods where both the dollar and gold increased together because investors were seeking safety during times of global uncertainty. This demonstrates why markets are rarely driven by one single factor. China understands these relationships extremely well. Its long-term strategy appears focused on strengthening financial flexibility. Diversifying reserve assets allows countries to reduce dependence on any single financial instrument. Many central banks have adopted similar approaches during recent years. That explains why official gold purchases have remained historically strong. India represents another important piece of the puzzle. Unlike institutional investors who may buy and sell based on economic forecasts, physical buyers often think differently. Families purchasing gold for long-term savings are less concerned about short-term volatility. They focus on preserving wealth across generations. This creates stable, underlying demand that helps support the precious metals market. Silver demand in India has also expanded beyond traditional investment. Industrial manufacturing continues increasing. Renewable energy projects require enormous amounts of silver. Consumer electronics continue growing every year. These developments create additional sources of long-term demand. Meanwhile, large financial institutions like JPMorgan constantly monitor global liquidity, credit markets, bond yields, inflation expectations, and capital flows. Their research teams analyze thousands of economic indicators every day. While nobody outside these institutions knows every detail of their strategies, their continued involvement within precious metals markets demonstrates that these assets remain highly relevant in modern finance. Another major factor receiving increasing attention is central bank buying. For many years, central banks were relatively quiet participants in the gold market. That has changed dramatically. Recent years have produced some of the strongest official gold purchasing activity seen in decades. Why would central banks increase gold holdings? The answer often comes back to confidence, stability, and diversification. Gold has survived every monetary system in recorded history. Empires have risen, currencies have disappeared, financial systems have changed. Gold remained valuable throughout each transition. That historical reliability continues attracting governments seeking long-term financial security. Silver shares many of these characteristics while adding another advantage. Its industrial importance continues expanding every year. Artificial intelligence data centers require advanced electronics. Electric vehicles require silver. Solar energy systems require silver. Medical technologies require silver. Modern communications require silver. As technology advances, silver demand becomes increasingly connected to global innovation. That creates an interesting balance. Even if investment demand temporarily slows, industrial consumption can continue supporting the market. Conversely, during periods of financial uncertainty, investor demand can strengthen while industrial demand remains stable. Few commodities enjoy both sources of support simultaneously. Investors should also pay attention to mining supply. Unlike paper assets, physical metals cannot simply be created whenever demand increases. Opening new mines requires years of exploration, environmental approvals, financing, infrastructure construction, and skilled labor. Production cannot expand overnight. If demand rises faster than supply, prices often adjust over time. Several mining companies have already reported increasing production costs. Energy expenses, labor shortages, equipment costs, and regulatory requirements continue affecting mining operations worldwide. These challenges make rapid supply growth increasingly difficult. If physical demand continues strengthening while production remains constrained, long-term market conditions could become more supportive for higher prices. Another issue receiving greater attention involves government debt. Many major economies continue carrying historically large debt levels. Managing these obligations becomes increasingly challenging when borrowing costs remain elevated. Markets constantly evaluate whether future monetary policy will prioritize inflation, control economic growth, or financial stability. Every policy decision influences investor expectations. Those expectations eventually affect precious metals. Gold has traditionally served as financial insurance during uncertain periods. Silver combines that role with industrial necessity. That combination explains why so many professional investors continue monitoring both metals closely. Perhaps the most interesting observation is not that China, India, and JPMorgan all participate in precious metals. It is that they approach the market from completely different perspectives. China focuses on national reserves. India reflects powerful consumer demand. JPMorgan represents institutional finance and global market activity. Different motivations, different objectives, yet all remain connected to the same asset class. When independent participants reach similar conclusions, investors should pay attention. It does not guarantee future price increases. Nothing in financial markets is guaranteed, but it does suggest that precious metals remain strategically important in today's changing economic environment. As we look ahead, the biggest question is no longer whether precious metals still matter. The real question is whether the rest of the market has fully recognized what some of the world's largest players may already understand. China continues strengthening its long-term financial position. India continues demonstrating consistent physical demand. Major financial institutions continue treating precious metals as an important part of the global financial system. Each of these developments tells part of the story. Together, they create a much larger picture. Investors should remember that financial markets rarely move in straight lines. Gold and silver will continue experiencing periods of volatility. Prices will rise, prices will fall. Short-term headlines will constantly change, but long-term trends often develop quietly before becoming obvious to everyone. That is exactly what history has shown time and time again. Think back to previous commodity cycles. The strongest rallies often began when public interest was still relatively low. Professional investors positioned themselves early. Central banks quietly accumulated assets. Institutional money gradually entered the market. Only after prices had already moved significantly did mainstream attention finally arrive. By then, many of the best opportunities had already passed. Could precious metals be following a similar pattern today? No one can answer that with certainty, but there are several reasons why many analysts believe the current environment deserves serious attention. Inflation has moderated but remains above long-term targets in many parts of the world. Interest rate expectations continue changing with every major economic report. Government debt keeps expanding. Central banks remain active buyers of gold. Industrial demand for silver continues growing through renewable energy, artificial intelligence, semiconductor manufacturing, and advanced electronics. Geopolitical uncertainty remains elevated across multiple regions. Each one of these factors supports continued interest in precious metals. Combined together, they create an environment that many long-term investors find increasingly attractive. Another important lesson is patience. Many new investors expect markets to reward them immediately. Real investing rarely works that way. Some of the greatest long-term investments required patience, discipline, and emotional control. Daily market swings often distract investors from the bigger picture. Experienced investors understand that successful investing is usually about following long-term trends rather than reacting to every short-term headline. Silver deserves particular attention because of its unique position. Unlike most commodities, silver benefits from both industrial growth and investment demand. If global manufacturing continues, expanding demand could remain strong. If economic uncertainty increases, investor demand could also strengthen. Very few assets possess this combination. Gold remains the traditional store of value. Silver offers both monetary history and modern industrial necessity. That combination makes it one of the most interesting assets to watch over the coming years. Of course, every investment involves risk. Markets can remain unpredictable for longer than many investors expect. Unexpected political developments, central bank decisions, economic surprises, or changes in global demand can influence prices at any time. That is why diversification, risk management, and long-term thinking remain essential. No responsible investor should make decisions based only on headlines or emotions. Instead, successful investing requires research, patience, and understanding of broader economic trends. Whether you are a new investor or someone who has followed precious metals for years, staying informed will always provide an advantage. The coming months will likely bring important developments: new inflation reports, Federal Reserve meetings, employment data, manufacturing numbers, central bank purchases, currency movements, and geopolitical events. Every one of these could influence gold and silver prices. Watching them together instead of individually provides a much clearer understanding of where markets may be heading. Perhaps the biggest takeaway from today's discussion is this: when countries with different economic systems, consumers with different motivations, and financial institutions with different objectives all remain interested in the same asset class, it deserves attention. That does not guarantee higher prices tomorrow, but it certainly makes precious metals impossible to ignore. History has repeatedly shown that major financial shifts often begin quietly. Only later does the wider market recognize what was happening beneath the surface. Whether this becomes another one of those moments remains to be seen. But investors who continue learning, studying market fundamentals, and following long-term trends will always be better prepared than those reacting only after the headlines arrive. Thank you for spending your time with us today here on Silver and Gold Watch. If you enjoyed this analysis, please support the channel by hitting the like button, subscribing, and turning on notifications so you never miss our latest updates on gold, silver, inflation, the Federal Reserve central bank buying, and global financial markets. Now, we would love to hear from you. Do you think China, India, and major financial institutions are preparing for a major shift in the precious metals market? Or do you believe something completely different is happening behind the scenes? Share your thoughts in the comments, because your opinion could help start an interesting discussion with other viewers. Thank you again for watching, and we will see you in the next video.